Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Brace, and let's get you up to speed with everything you need to know. Taking a look at the market action, stocks holding on to gains here. Looking at the Dow up just about 100 points. Now, among the biggest movers of the day is EVgo, and that's a provider of EV charging stations. Now, shares are surging higher. Look at that, up just about 22% after the company reported better than expected fourth quarter results. We are going to speak with EVgo's CEO coming up.
And shares of Block are on the rise. The payments company firing back at a short seller that accused the company of inflating some of its metrics. We have Block's response ahead in the show.
But first, let's get you up to speed on the latest developments out of Washington. Now, the White House has announced its plan to strengthen bank regulations following the collapse of Silicon Valley and Signature banks over the last several weeks. Yahoo Finance senior columnist Rick Newman has the details for us. Rick, what can you tell us about this plan?
Hey guys, basically what the Biden administration wants to do is reinstate many of the regulations that were in place before Congress and the Trump administration weakened them in 2018 and 2019. And the short version of what they want to do here is basically lower the threshold for the tightest set of regulations. What happened back in 2018 and 2019 was some of those rules, instead of affecting banks at the 100 billion level of deposits, it went all the way up. Those didn't kick in until $250 billion of deposits. So there was this gap between 100 billion and $250 billion where the smaller banks had lighter regulation. And basically the Biden administration is saying, let's just lower that threshold. So basically all the banks from $100 billion on up would be subject to the strictest regulations. And that would have included both of those failed banks, Signature and Silicon Valley. And they also say they can do this just through regulation. Congress will not have to pass a new law. And my understanding is actually they can do that. So the Biden administration is basically telling the Fed, the FDIC, and some other agencies, this is what we want you to do. We'll see if those agencies actually do it.
Rick, what would this have changed? If these were in place, could this still have been missed by the Fed, by regulators together?
It could have been missed, but I'll hear a couple of examples. The smaller banks, the lower threshold, they are only required now to undergo a stress test to see how they would handle an adverse situation once every 2 years. And under the new rules, which would be the same as the old rules, that would have to happen every year. And they would also compress the amount of time that you are obligated to undergo one of these stresses once you actually cross that threshold. So Silicon Valley grew so fast that it kind of just got stuck in a bit of a time warp where it was getting pretty big. In fact, it was almost as big as the big banks at 250 billion, but it had not come under any of those new regulations. So those are some examples. Basically, treat smaller banks the same way we treat the big so-called too big to fail banks.
Okay, good stuff. Rick Newman, thank you, sir. Appreciate that. Now let's get you up to speed on the Fed's path for rate hikes. Yahoo Finance senior reporter Jen Schomburger here with the very latest. Jen, good to see you. What did we learn today?
Good afternoon, Dave. Good to see you. Two Fed officials were in favor of raising rates a quarter percentage point last meeting, despite the bank failures, because inflation remains too high. Boston Fed President Susan Collins said raising rates by another 25 basis points was, quote, appropriate amid high inflation, despite uncertainty from the impact of the bank crisis. Collins also said she anticipates raising rates another 25 basis points from the current range of 4.75% to 5% to a new range of 5 to 5.25% and holding there through the end of the year. Though she said before the recent bank failures, she was keen on raising rates higher than current projections. Quote, recent financial sector stress has increased the uncertainty around appropriate monetary policy. She goes on to say, recent developments will likely lead banks to take a somewhat more conservative outlook and tighten lending standards, thus contributing to slowing the economy and reducing inflationary pressures. These developments may partially offset the need for additional rate increases. But Richmond Fed President Tom Barkin said in a speech in Richmond today that it's too early to know whether banks will tighten credit enough to slow the economy. He said he saw the banking system as resilient at the time of the last meeting and favored a 25 basis point hike, noting, quote, substantial inflationary pressure. Barkin still sees a range of potential outcomes as pretty wide. He said if inflation persists, the Fed can react by raising rates even further. We also heard from Minneapolis Fed President Neil Kashkari this afternoon, who says it's unclear whether a credit crunch will result from these bank failures, and it's going to take time for these strains to work through the banking system. Back to you.
We shall see in the months ahead. Jen Schomburger, thanks so much. Appreciate that. Several big tech stocks rising today. Names like Apple, Alphabet, and other big tech stocks that formerly made up the FANG group are having their best month against the rest of the S&P since July 2011. Here to talk more about the outperformance is Callie Cox, eToro USA investment analyst. Nice to see you, Callie. So is big tech now defensive?
It seems so. Big tech for so long was thought of as this growth stock kind of group, and it fit the profile pretty well. But now that investors are looking for safety and they're looking for quality within the stock market, they're looking for those healthy profit margins, those strong cash hoards, and durable balance sheets. It seems like they're giving an eye toward big tech and turning away from those smaller speculative tech companies.
So, Kelly, is the bull market that we are seeing play out in tech, is that just beginning?
It's a good question, and I think it depends a lot on what we see from the economy and the Fed's response. There are a lot of balls up in the air right now. I know you mentioned earlier that we had some Fed speakers saying that the Fed could hike rates even more, and I think that just speaks to the fact that inflation in this moment has not been controlled, and that's a big headwind for tech at the moment. But again, when rates are high and operating costs are rising quickly, then as an investor, it does behoove you to look more into quality, and that can benefit big tech again. It just may not benefit the entire tech sector because there are a lot of filters out there.
Do you anticipate another 25-point hike in the next meeting, and how might that impact this shift to tech?
I think it would make sense for the Fed to pause here. It's definitely a rock and a hard place for the Fed at the moment, but going by what they know, inflation is still quite high. And if they pause, they can keep rates high and see how the effects move throughout the economy and then respond as needed. But I think with the banking situation where it is right now, certainly could be a risk to growth, but it's too early to tell. It may make sense for the Fed to pause, although who knows? They've surprised us before.
Kelly, you have new data on your retail investors from Q1. How are they positioned? How exposed have they been to the recent turmoil in the banking sector?
So retail investors have been resilient for quarters now. They are getting a little more pessimistic, even though they're diversifying. They're not necessarily selling out of the market, but they are getting a little more pessimistic about the economy and about the state of the U.S. markets. And to counter that, they're going global. They're looking at global opportunities. They're looking at other asset classes. They're raising some cash, not because they have to, but because they see opportunities in the market ahead of them. And they want to have enough dry powder on the sidelines there. But one risk that we're watching is that they are quite exposed to this banking crisis. Of course, many Americans have a savings account, but financials are actually the second most held sector among U.S. retail investors we surveyed, which is a worrying fact considering they got hit so hard this month.
Also, part of that data shows the holdings of crypto, which one might expect in this environment and given the crisis we've seen there with some banks. Investors fleeing that space, not exactly what the data is telling you. Why do you think that is?
Yeah, so it's really wild. We do this survey every quarter of 10,000 global investors. And even though crypto had such a rough year last year, allocations barely changed, or retail investors' allocations barely changed. They went from about 29% in Q1 of last year to 26% of their entire portfolio this quarter. And what that shows me is that there's a lot of hodling going on. There's a lot of holding on because we do have a lot of long-term investors in crypto at the moment, especially with so much speculation being washed out, and they may not feel emboldened enough to trade or speculate a little bit more, but they believe enough in the power of the technology and in the decentralized properties, which is a big feature these days, to hold on and see where it goes.
So, Kelly, that's how the retail investor has been positioned through Q1. How should they then be positioned for the remainder of the year?
Well, we're turning cautious here. We put this out about a month ago, but we got a little cautious once the S&P crossed 4,000 before the banking crisis, and it seemed like inflation wasn't coming under control as quickly as we thought. So right now, with the banking fears definitely top of mind, and growth potentially slowing. We're encouraging customers to think about how they can turn defensive, but hold on to a little risk as well. And I think that comes back to quality. It comes back to the companies that you're investing in, knowing why you're invested in them and how they make money.
But you also got some data on job security. And what did you find out in that regard?
Yeah, so this was another interesting part of the survey we did. So we asked retail investors how confident they feel about a number of things: the economy, their living standards, their job security, their investments. And we got a few interesting tidbits this time around, but the one that jumped out to me is just how confident investors are in their job security. And it makes a lot of sense. You look at the job market and it's still incredibly strong. It's one of the reasons why the Fed is still feeling inclined to hike here, because it's a bit out of balance. But for me, for the Fed to cut rates, to be worried about a recession, we really need to see some evidence of breaking down within the job market. Obviously, I don't want that to happen. Best case scenario is the Fed can get inflation down without roiling the job market. But for now, that's where I'm looking when I think about where markets could go from here.
Kelly, do you think you'll see any sign of that in next week's report?
I think it's too early to tell. If you think that, the banking headlines could cause some growth scare, I really do think it's too early to tell. Layoffs are still quite low. We may see some tightening credit standards, but that could take some time to work through the economy. I don't see any indication that hiring has slowed down, but that doesn't mean the trend can't change over the next few months.
Kelly Cox, always great to hear from you. Thanks so much. Let's do a quick check of the market, sponsored by Tasty Trade. All three of the major averages holding on to gains. You have the Dow up just about 96 points. You look at the S&P up about 0.4% and the Nasdaq up about 0.6%. In terms of the sector action today, real estate, technology among the leaders in today's action. Financials under a bit of pressure, off just about 0.4%. Well, we are just getting started here on Yahoo Finance Live. Coming up, Roku announcing a second round of layoffs. Find out what the future could have in store for the streaming platform. Mortgage rates are heading lower. Will it be enough to get more buyers into the housing market? And shares of Intel are on the rise once again after the company says that its new chips are coming sooner than expected. But is now the time to buy? We're going to discuss when we come back. Let's check on shares of Roku. That stock under pressure, off just about 4%, now falling despite the fact that the company announced a second round of layoffs. This time, the company is cutting 6% of its staff. Now, this news follows yesterday's announcement from EA that company is cutting some of its positions. Yahoo Finance senior tech reporter Ali Garfinkel is here with the latest. And Ali, I think a lot of the talk here when it comes to Roku, when it comes to EA especially, some of these cuts, are they positioning themselves to be acquired? What do you think?
It's a great question, but I think there are two parts to consider here. The first is the buzz of what might happen, right? And then my instincts. So the buzz, right? There's always these murmurings of consolidation in media and tech. And for Roku, there actually have been a number of acquirers who've actually been floated over the last few years. And there's some of the biggest names out there, right? Google, for instance, in 2020, and then Netflix last summer. Actually, last summer, when Netflix hit headlines as a possible acquirer for Roku, the company's stock shot up. So the street like it. The street likes the idea of Roku getting acquired, certainly. That said, my first job was as an M&A reporter. Did you know this?
I did. That's why you were the perfect person to ask.
Yes. And philosophically speaking, right, a deal is a fault line, right? It's a moment where there's a gap between what a company aspires to and what it actually has, right? And I think the question about Roku is, what does Roku have, right? They have this OS, they have an advertising network, they have a subscription business, they have this fledgling TV business even, right? And who needs that, I think, is the question investors should be asking as we're trying to figure out whom it might be. The reality is I'm not expecting anything imminently, Shauna. It's a difficult deal-making environment right now. Deal makers famously do not like high interest rates and economic volatility. So deal-making is done for now, but not forever, right? I have a lot of sources who said to me, for instance, that deal-making should probably pick up in the back half of 2023. So maybe look for something to happen with Roku then, and definitely in tech and M&A more broadly.
But you didn't answer your own question, which is who does need that? Is there usual suspects?
I think it's an interesting situation because
I've been thinking about it the whole time, and no one comes to mind.
No one comes
in particular,
to
because they started making TVs.
Well, this is right. It feels
in
some ways it's the logical thing to make TVs, and in other ways it's completely out of the blue, right? Yeah. So I actually think you're right, Dave, because I think there's a key problem with Roku, which is there's a couple of possible fits, right? Like you see how Google might want it, you'd see how an Apple might want it, you'd see how a Netflix might want it. That said, there's no real Cinderella glass slipper perfect fit for Roku, is there? It's also a mega deal, right? In the end, it would be a deal. I think Roku's market cap right now is around $9 billion. It would be a pretty big, highly leveraged deal. Someone would really have to believe in Roku and really want it to make that deal. And yes, they're cutting. It's a pivotal moment for them, definitely. They're clearly trying to get operating expenses right, but they still clearly have a long way to go there. Reading that SEC filing, even if they're slimming down for this deal, even if there was that magic slipper fit, that magic glass slipper fit, I don't know if it would even be the right time now. Does that make sense?
It does. And you get the sense the tech layoffs are far from over, so you'll be back soon, sadly, on that regard. We always love having you on that regard. That's how I couch that, you see? Ali, good to see you. Good job. All right, let's take a deep dive into Roku. Now that the company has announced its second round of layoffs in 4 months. Joining us now is Tim Nolan, Macquarie Senior Media Tech Analyst. Shares fell today, sir, counterintuitive from what we've come to expect when we get layoffs. Usually we see that share price pop up a little bit because of the cuts, but we're losing 4% on the day. Why?
Well, I don't know. You might think that on a cost savings announcement, the stock might rise. Now, Roku has been pretty clear, from their earnings in the middle of February that they would be looking to contain costs this year, and they had previously announced job cuts. So I think the balance here is that I think investors recognize that Roku has a lot on its plate. There is a lot that they should be investing in. I mean, this company is facing the operating system wars now, facing up against big competitors like Samsung and like Amazon Fire. And they've got a big international expansion plan, which has a long way to go. They haven't gotten very far with it yet. They also have to make changes into their ad platform and how they serve and deliver ads. So there's a lot of potential upside if Roku can get it right. And, maybe the stock is just reflecting, the balance between if they're cutting staff versus they need to be working on a lot of things very actively right now, then where does that put the stock?
Tim, how do you view Roku just as a standalone company here in the future, given the fact that so many of its competitors are bigger than they are right now, versus the fact that maybe they could be an attractive acquisition target for some of those larger players?
Well, maybe on the last point, I'll just add that Roku, one of the advantages of Roku is its independence. There is no conflict with other, TV network groups or fast services or any of the apps on its interface. There's no Roku does not have a conflict with any of them. If somebody were to acquire Roku, you would immediately have a potential conflict. So the independence that Roku has always been one of its advantages. I just think, going back to what I was saying before, the company is facing now, it's a very competitive market, but they've always done well in these competitive markets. I mean, Apple TV and Amazon Fire and Google Chromecast have always been major competitors for Roku's streaming hardware. And they are still the leading connected TV platform in the US, despite that. The next trick is, can they expand internationally and do that effectively? So they don't have the brand, they don't have the market position internationally that they've had in the US. They've done well here. They've done well in Canada and Mexico, but there's a long way to go in a lot of countries they haven't yet entered. So I think that's kind of step one. And step two, don't forget, the real business of Roku is advertising. I mean, the devices give Roku the installed base upon which they sell advertising through the apps and on the Roku channel to consumers that are on that platform. There are 70 million active accounts on Roku. The real growth is to grow the advertising. That's clearly in a cyclical soft spot right now, advertising is. And Roku, in addition to the cyclical weakness, has to focus really on how to become a more automated advertising business. There's a lot of connected TV advertising money to move over. Roku has to understand how to grab that and how to grow into that.
Is there a logical dance partner, someone that could use their assets?
I won't name names. You named some on the prior segment. There are lots of companies that I suppose might have an interest in Roku. But again, the independence that Roku offers to everybody using its platform, I'm talking the companies using its platform, is one of its advantages.
Tim, let's move over to Disney, another company that you cover here. Lots of questions just about the future of the streaming there at that company, what exactly that looks like. Let's start it off with ESPN. What do you think the fate of ESPN looks like when you take into account some of Disney's future plans with its streaming business?
Yeah, there's a whole lots of bags of worms here in this question, ESPN as well as Hulu. Since Bob Iger came back, I think as CEO of Disney in November, I think there's been a lot of new questions have emerged. One is a recurrence of a long asked question by investors: what will Disney do with ESPN? I think Bob Iger has made pretty clear that ESPN is considered a core franchise within Disney, and they want to own it, and they want to find a way to convert it into a more active streaming service. Of course, ESPN Plus is a streaming service. It does not have the same content as the ESPN linear service. And we've begun to think there might be a couple of catalysts at play here that could accelerate the process of ESPN becoming more a truly OTT service. And that is, one, you've got the NBA rights renewal. That contract is due up at the end of the 2024-25 season, but these contracts usually get done a couple of years in advance. So we don't know, but I believe that the NBA national contract is being discussed right now. And for sure, there's got to be a big streaming component to that. In addition, you've got these regional sports networks. Sinclair Broadcasting just went bankrupt, or at least the Diamond Sports component of Sinclair has just, gone bankrupt. And that represents half of the NBA and half of the Major League Baseball and half of the National Hockey League games across the country in those regional markets. So look, there are a lot of legal questions here. There are a lot of logistical and strategic questions here. But, we posit the view that what if ESPN Plus were to take NBA national streaming rights as well as regional streaming rights, put it into a package, and offer a tier on top of the existing ESPN Plus service. Offer that out to NBA fans. I believe they could monetize that effectively with streaming subscriptions. Clearly, the advertising that would be supportive of that, and they could support the rights. Doing so, I believe, could be profit-making for them. It would certainly raise the question of what happens to the rest of the linear pay TV bundle if they're going to be moving premium content from the NBA onto ESPN+. But this is the kind of thing that I think is going to happen. I don't know if this exactly happens the way I just described. This is the kind of thing that's going to come to sports streaming in any case, and I think ESPN has a leading position here.
All right, we asked you about some intrigue with Roku. Got to get your thoughts on Needham's Laura Martin, who says Apple will be worth 15 to 25% more if they buy Disney. Could something like that ever happen? How would it impact Disney?
Wow, the M&A questions today. I don't know. I don't want to wade into that specifically, but I would say I believe there is a lot of value in Disney. I believe it is the one traditional media company that has the best chance of transitioning to a streaming world successfully. They've already done this with Disney Plus. They still have to shed the old linear business behind. But here's one number for you on ESPN. ESPN pay TV subscribers have fallen from 99 million at the peak to, I believe, 74 million. That's just the cord cutting, the traditional bundle falling down. ESPN Plus has 24 million subscribers. That's almost exactly the same number. It's not apples to apples. The content is different. The pricing is different. But that's an indication of how I think Disney can translate from the old world into the new world. They're already well along the path. And I think there's a lot of value within Disney that's not being appreciated fully in the stock price. And who knows, there might be other companies out there that might see that value as well.
That is plenty of intrigue there. We'll take that, Tim. Appreciate it. Thank you for that. All right, coming up here next on the show, new data shows millennials no longer make up the largest share of home buyers. Find out who does at nearly 40% when we come back.
So a quick check of the markets sponsored by Tasty Trade. Once again, all three of the major averages holding on to gains. Looking at the Dow up 129 points. S&P up about a 0.5% here, hitting the highest level that we've seen in just about 3 weeks.
All right, mortgage rates moving for a third straight week down. The average 30-year fixed down to 6.32% from 6.42 1 week ago. That's according to Freddie Mac. Down from north of 7% in early November, of course, far more than the 4.67 1 year ago. Let's talk about the housing outlook with Lawrence Yun, National Association of Realtors Chief Economist. Good to see you, sir. So what is driving these rates down, and where do you believe they will begin to flatten out?
Good afternoon. Certainly, the mortgage rates are becoming much better for the consumers. I think the consumers recognize that 3%, 4% mortgage rates of the COVID period, those were special circumstances, bonus conditions. The new normal could be around 6%, and essentially that's where we are. And for people who are considering buying, well, someone who may have been priced out at 7% are now beginning to be very eager as the mortgage rates are approaching 6%. But the reasoning is very simple. The Federal Reserve is in essence is saying maybe there's only one more rate hike or maybe none at all, given the regional bank a little wobbleness in that sector. So therefore, the mortgage rate has pretty much already topped out. The key question is, are we going to have sufficient supply to adequately meet some of the potentially rising demand?
And Lawrence, what are you seeing in terms of supply, those inventory levels, which we know have been very, very low now for quite some time? How big of a challenge is that still here for the market?
It is a big challenge. We have only 1 million homes out in the marketplace. Pre-COVID, it was closer to 2 million. So the inventory situation has not really improved. And therefore, we need to think about supply, bringing more supply, giving the incentive for the builders. Maybe there's too much regulation for home building activity, land use regulation, and also consider some of the zoning so that we can produce more housing rather than be restricted by zoning regulations. So we have to really think about bringing more supply to the market, because clearly there is a pent-up demand. Millennials did not participate in the market in the last year, but there is an aspiration for home ownership among the younger adults, and we need to assure there is adequate supply to meet that future demand.
And we're seeing some of that shift in new numbers that show baby boomers have overtaken millennials as the largest generation of home buyers, nearly 40%. That's up from 29% a year ago. What's behind that shift?
It's essentially saying that last year, in a period of fast rising mortgage rates, it squeezed away the first-time buyers, while for existing homeowners, they saw substantial price gain, 30%, 40% price gain in short 3-year time span. And therefore, for existing homeowners, they can always sell their home, use the proceeds as a down payment for their next purchase. But for the first-time buyers, they don't have that luxury. They're looking at mortgage rates, and rising mortgage rate essentially squeeze them away. And from the future perspective, I mean, we want home ownership opportunity for all age group. So the high mortgage rate last year really killed off the younger adult generation.
Yeah, and Lawrence, more specifically to that point, when we talk about how much of the first-time home buyers, the percentage there that they make up of all of home purchases, where does that stand now? And do you see that changing anytime soon?
Last year, exceptionally low. Only 26% of all home buyers were first-time buyers. Pre-COVID days, we would have said closer to 40% as being normal. So Federal Reserve clearly need to understand that when they raise interest rates, it will cause some harm to the economy. We are seeing it in the regional bank, but also from the home buying opportunity, rising interest rate is essentially limiting people of middle income or moderate income, or people who are on the more better situated circumstances. Baby boomers have already accumulated wealth. I mean, they're in a much better situation. So one has to consider, especially in light where we have so much apartment building construction occurring in the country, well, rents will surely come down, which means CPI, consumer price inflation, will come down towards the year end. So maybe the Fed can stop raising interest rate knowing that inflation will be coming down.
I want to get your thoughts quickly on this LA mansion tax, which goes into effect on Saturday. You're seeing a rush of sellers trying to get their home not just sold, but closed by Saturday. Is that a smart move? And what is the net impact of it?
Not a good move. It just means that Los Angeles is saying, well, look, if you succeed in life, you have some wealth, we don't want you around here. So I think there will be a large out-migration away from LA. Maybe they will go to Arizona, Nevada. So in the interim, maybe they collect some mansion tax temporarily, short term. But over the long term, they have lost out on many productive individuals as they have gone to other states.
Lawrence Yun, really appreciate you being here. Thanks so much.
Thank you.
All right, coming up, Evercore is shifting to a more bullish stance on Walmart. We'll tell you why next.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading: Walmart, Block, and Under Armour. Let's start with my play, and that's Walmart. Evercore upgrading to outperform, touting the retail giant's scale and stability. Now, they also say that Walmart has gotten a hold of its 2022 inventory problems and views those issues of the past. Now, store traffic has also been trending to the upside. While it's still below those pre-pandemic levels, it's actually been increasing for 7 quarters in a row right now. And success at Sam's Club is another thing that was called out in this report here by Evercore. Evercore saying that the club is building some of those loyalty brands that we know that is so important here for Sam's Club through its membership. It also thinks that it's going to continue to outperform as inflation remains sticky, at least for right now. So new price target of $160, still plenty of upside to go. At least Walmart thinks so, and it makes sense in this environment.
Yeah, there's a lot of positives in that note. They also pointed to web traffic, which is above pre-pandemic levels, above 2019, above 2020, a little bit lower than the last couple of years, probably because more people are going back to the store. And another interesting graph in there, Dave, that kind of caught my eye was the groceries. We talked about that a lot at Walmart's after Walmart's last earnings, but groceries now for 4 quarters in a row, double-digit growth. It'll be interesting to see if that keeps going up, because that is something that Walmart has that some of these other, some of their competitors don't have when you talk about people trading down and buying groceries at Walmart.
And backing up the narrative, the National Retail Federation yesterday said they estimate retail sales increasing 4 to 6% this year. That is above the pre-pandemic average of 3.6%, but we'll get a better glimpse at Walmart Investor Day on April 4th and 5th. That's next week.
My play today is Block. Shares rising as the company responds to a recent report from short seller Hindenburg Research. Block saying in its second response to Hindenburg since that report that 44 million of its 51 million monthly active customers on Cash App are verified through its identity verification program. Block states that 44 million number represents roughly 97% of Cash App inflows in December 2022. Now only 39 million of those accounts are attached to unique social security numbers, so about a 5 million difference there. Hindenburg Research claimed 40 to 75% of Block users were fake, obviously a big discrepancy from what Block is saying there. And another key point from Hindenburg that could still be under question, Hindenburg had cited Block's reliance of bad actors and criminals as a key part of Block's business. Block said it froze 2.4% of accounts in 2022 through its security protections. Mizuho analyst Dan Dolev says in his research today that Block's response was a positive note, but he is still wondering how much of that criminal activity is part of the gross profit. He thinks they still have some questions to answer come the earnings call when we finally hear from Block again, and there'll be more questions, I think, asked to them.
There's no question there are more answers that need to come. But D.A. Davidson got ahead of this a couple of days ago, 2 days ago, in fact, saying it's a compelling short-term buying opportunity because they believe Hindenburg case is, and I quote, considerably weaker than the market reaction implied. They also added that Hindenburg's fraud claims were grossly overstated. Again, that was independent. That was D.A. Davidson ahead of Block's response today, Shauna.
Yeah, certainly. And I think resoundingly on the street, they are taking this as very positive just in terms of some of the concerns that have been raised from Hindenburg ever since. And this response here from Block obviously putting some of those concerns to rest. You were right, though, because Dolev wasn't the only person to bring up the fact that we probably will need to hear more when it comes to some of that fraudulent activity. The analyst at KBW was also raising some of those concerns, but again, had a more positive outlook just given the high number of active users right now and how much that really translates to the number of transactions.
And I'll add, Dave, I just looked for shares are about $5 cheaper now than when they were before the Hindenburg research report. So that's sort of what D.A. Davidson's going off of there. Slow climb back up, but they're still about $5 cheaper than before the report. So
could be some opportunity there. My play is Under Armour, today the Baltimore-based apparel brand extending their deal with Warrior star Steph Curry to what's expected to result in one of the richest endorsement deals in sports history and what could amount to a lifetime deal. As part of the agreement, Curry becomes the president of Under Armour's Curry brand, and he'll work on golf, youth sports, sports style, in addition to basketball. The two-time MVP, four-time NBA champ, initially signed with Under Armour in 2013 for around $4 million per year. His current contract is worth a reported $215 million, expires in 24, and includes equity in Under Armour, and that, of course, is the key. Said the founder of Under Armour, Kevin Plank, "I couldn't imagine Under Armour without Steph, nor Steph without Under Armour." Shares relatively flat today and down 5+% this year, 47% over the last 12 months as they try to compete with Nike. There are reports from Rolling Stone that this is what equates to a $1 billion deal with Steph Curry, but again, no numbers from Under Armour, and of course it depends on what that equity is worth. The real question is, Josh, how much of a difference maker is he? Because look, Steph Curry, and I'm not afraid to say that he has changed the game of basketball more so than Michael Jordan. Sure. And people can get mad at that all they want. He has changed it at every level, youth, high school, college, the pros. He's changed everything we know about the game fundamentally. Again, more than Magic, more than Jordan. Right. But will the shoes move the needle? We're not going to compare it to the Jordan brand because they did $5 billion in revenue 25 years after Jordan retired.
The key here is going to be, can they make Steph Curry cool from a lifestyle perspective? Boom. I think right now Steph Curry's shoes are cool to wear on the court, and his basketball shoes are pretty popular. Yes. But he hasn't had that Jordan effect where once he retires, people don't wear shoes of retired guys on the court anymore. That's not really that cool for kids. So you've got to get to the lifestyle part of it. I think the golf tie-in's pretty cool. Steph Curry is a big golfer. He'll probably have a presence in the golf game post his career. But I don't know, Shauna, I was surprised about the amount of athletes that you kind of can't name that are sponsored by Under Armour. And it's not like the Nike group that I think is kind of famous and really drives a lifestyle brand. We were looking them up earlier, and some of the names are like that. They're sponsored by Under Armour? Yeah, I didn't remember that.
Yeah, they caught us a little bit off guard. We didn't even realize that. That's so true. And I think part of this deal and part of the reason why Under Armour is keeping Steph Curry is also just his ability to attract other very large name, well-known athletes that Under Armour is hoping they will be able to come out with their own lines, they will be able to attract that user base, because look at the numbers, look at their performance over the last several years. The company continues to struggle. We know inventory has been a massive issue for Under Armour. They have been promoting as much, or if not even more, than some of their competitors out there. So huge win, I think, for Under Armour. Obviously, with that potential payday, makes sense for Steph Curry, too.
Yeah, it'll be interesting. I think it's a similar question that Adidas faces with arguably the most famous athlete on the planet, which is Messi. Can he translate? Can they develop an off-the-field shoe? Neither have really made much of an effort or had success off the field. That may be the
It's just crazy quickly when you think about it. If I had told you a decade ago that Under Armour got Steph Curry before the Warriors won all those championships and before he got this big, you would think they'd have a bigger presence in basketball, wouldn't you?
No question about that.
That's true. He's so likable, too.
Right. You know, Steph Curry is awesome. The Warriors they're fun to watch, and it just hasn't taken off to that level.
All right, guys, we got to leave it there. But coming up next, luxury home sellers in Los Angeles are rushing to complete their sales by this weekend. Find out why when we come back.
Thinking of moving out of your LA mansion? Sellers beware. There is a new tax in town for residents of Los Angeles. It takes effect on April 1st and has some owners scrambling to sell their houses. The tax, called Measure ULA, was on the ballot in November of 22 and passed by a margin of 58% to 42, according to Ballotpedia. It imposes an added fee for sellers of homes over $5 million in LA, Shauna.
Well, there's a tax of 4% for those properties that are selling for $5 million and up, in between there, 5 to 10 million, I should say, and a 5.5% tax on homes over 10 million. Well, that tax money, that's going to fund affordable housing projects and also provide resources to tenants at risk of homelessness. Now, it's important to note that this is an additional tax on top of a base rate, and all LA residents right now who are selling homes, they pay a base tax rate of nearly 0.5%. So Some quick math done by our producers here. If you sell a $10 million home in LA after April 1st, you are going to have to cough up nearly $600,000 in taxes.
Whether or not you profited on that home or not,
Exactly,
you could have taken a loss, right? For more on this, we're joined by Josh Altman, star of $1 Million Listing LA. Good to see you, my friend. How you doing? What do you make of this new tax? What's been the impact?
I'd be doing a lot better right now if this tax didn't go through. I can tell you I have seen more deals get done this month, in the month of March, than I've seen in my entire 20 years of being in some aspect of real estate. It is just out of control right now. The last 72 hours, I had to run away from the office just to do this. Everyone's trying to close. The clock's ticking. 2 days. It's all done. I've been seeing deals get done that shouldn't be getting done. And I've been seeing things get thrown in that should never been thrown in deals.
Well, Josh, what's it going to do, though, for the real estate picture in LA? Are more people that own homes or want to own homes, I should say, that are above that $5 million threshold, are they going to look elsewhere?
Yeah, they're absolutely going to look elsewhere, which is the problem with this measure that was passed. Yeah, of course, it's great because it helps homeless and affordable housing, but they didn't think about the other side of this measure here, where it's going to actually chase people out of LA that are going to take their thousands and thousands of jobs and employees that they employ with them. So it's going to be really bad for the market, in my opinion. We've only seen the start of it. And when you think about it, it's going to trickle down all the way to the bottom. If people think they were not going to be affected because they don't have homes that are worth more than $5 million, I promise you they are going to be affected because their houses too are going to go down in price.
Reports one of your peers offering a Bentley to a seller to close by Saturday. What are you doing to try to entice buyers, sellers, agents to get the deal done by Saturday?
Unfortunately, a lot more than a Bentley. I think our biggest gift has been $1 million bonus on top of the commission if we can close. Unfortunately, that one did not work out for us. We have not closed before the deadline, and you know it's not good. It's not good all around. It's not good for the market. A lot of people didn't even understand what this measure was when they were either voting for or against it. And you know, I called about 250 of my own clients to explain to them so they could get out and vote, and they had no idea. It's going to hit everybody pretty hard here.
Josh, when we talk about why this tax has been implemented or will be implemented on the 1st, it's because that they want to raise money here to create more affordable homes in that area. Was there a smarter way to go about doing this, and what would that have been?
Well, yeah, I can tell you the smarter way. If you're going to tax people, tax everybody. Don't just tax a few successful people that happen to live in a house that's $5 million or more. And by the way, in LA, that's not a mansion, okay? That's a 4-bedroom, 4,000 square foot house. So if you're going to tax on the profit that's made on the house and tax across the board. The issue is these people that have bought houses 2 years ago, and for some reason they want to sell their house now, not only are they going to be down because the market's down, but now they have to cut that 4% and 5.5% check out of their pocket off of their loss. How crazy is that?
Trusting the government with the real estate market. What could go wrong, Josh? Yeah, you could take a loss on a home and still have to pay this tax. I do want to ask you about the market prior to all this. Wall Street Journal out with a piece basically citing a real estate of two different stories. One on the West Coast of falling prices, one on the East Coast of rising prices. What are you seeing out there in general?
Well, I think we saw a steady decline over the last 8 months. But of course, this is when we hit the wall now. It'll be interesting to see what happens over the next 8 weeks. There has been similar taxes, none of this size in other states like New York and other places. So we'll have to see how it actually comes into play. Who's going to end up paying for this? Is it going to be the buyer? Is it going to be the seller? Is it going to be the real estate agent? I think everybody's going to have to move a little bit until hopefully this will be turned over. It's already in the works. I don't know what's going to happen in the meantime. All I know is I got a lot of clients with a lot of big houses that are looking to move to Florida, Texas, Vegas, and other places.
Yeah, Josh, speaking of that, the ripple effects of this, what are you hearing from your peers in other cities just in terms of the fear out there that a tax like this, what we're seeing in LA, that it's going to spread even further here across the nation?
Yeah, so this is in LA, minus a couple parts like Beverly Hills and Malibu. There is a lot of fear. It's already been done in Santa Monica, even in our office down south in Newport Beach. They're getting worried that this is going to go down there as well. So it's going to affect across the board. And again, I'm all about housing for homeless, affordable housing, but there's better ways to do it. And it's not just on houses. It's also on commercial properties, investment properties, across the board.
It's an uncertain environment ahead, but what about $1 Million Listing season 15? What's the plans?
Well, let's see how that affects $1 Million Listing season 15. All I know is we just did have the biggest month of our career, not because I wanted it to be, but because unfortunately it was a race to the finish line, and we closed over $200 million this month in real estate. But I have a feeling we're going to have to save that money for a long time coming.
All right, Josh Altman of the Altman Brothers and star of $1 Million Listing Los Angeles. Josh, thanks so much for joining us.
Thank you.
Well, coming up, we are counting down to the closing bell on Wall Street. Still, the Dow up just over 130 points. We'll be right back.
All right, just a couple of minutes away from the closing bell. That's time to bring in Yahoo Finance's Jared Blickery to break down the market action. It's been overwhelmingly positive as of late, and?
Yes, it has. A day after the Nasdaq 100 goes into a bull market, we got another day of gains here. We'll see how long it can last. The Nasdaq up 0.7%, the S&P 500 a little less, and the Dow up 0.4%. And let's get to some heat maps here. In the Nasdaq 100, a lot of love for the mega caps today, except for Alphabet. And let me just put a percentage chart. There we go. We're seeing Amazon up 1%, so is Microsoft, Nvidia, Meta. Those are also up 1%. But let me show you what's happening in the sector action. Real estate, interestingly, that is in the #1 slot, along with tech, consumer discretionary materials. That rounds out the motley crew of our leaders here. Not kind of a rhyme or reason that I'm seeing why those particular four should be in the lead. Nevertheless, financials, those have been having a lot of trouble over the last month. Those are down to 0.2%. And then taking a look at some of our leaders here, looks like solar, that is the #1 performing ETF. We got TAN up 2%, KWEB, that's a Chinese internet ETF, up a little bit less, BETS, that's a gambling ETF, and SOX rounding out the top 4 there. Let's take a look inside the tech, and we're going to start with semis here. We can see Lam Research, and less than a minute to go here, by the way. Lam Research up 3%, ASML up 2, NVIDIA up 1.5. Not seeing too many stands out. In the software field, we got Snow up 3.4%, Microsoft up 1, and then just a few red spots dotting the landscape. Let's take a look at that banking screen, and we can see more red than green here. Wells Fargo notably down 1.5%, but of course, regional banks where the action has been. 15 seconds left here. Just want to show you the biggest winners and losers today. MCB down another 27%, Metropolitan Bank Holding Corp. So with that, here's the bell.
All right, well, that does it for today's trading day. Again, all 3 of the major averages trade ending to the upside, and this market check sponsored by Tasty Trade. The Dow up just around 143 points. S&P up about 0.6%. You look at the Nasdaq also adding to some of those gains. There's some of the outperformance in some of those chip stocks and also the larger cap tech names among the leaders today. All right, let's take a look at some of the individual movers of the day. First up, we got to take a look at Roku. That stock closing off just about 3.5%. Now the move lower coming after the company announced a second round of layoffs. This time, they're cutting 6% of the workforce. And Dave, when you take a look at the reaction here in the stock price, it could be a bit of a surprise. You would likely think that when a company cuts costs, you would see the stock price rise, except for today, we're looking at losses once again here for Roku.
Yeah, quite typically in the last quarter, we've seen share prices rise after layoffs. Not the case with Roku, and in the words of Tim Nolan, that's because they have so much on their plate. This is a company that has a lot of issues to take care of, and that's why overall the perception is not one that their only challenge would be containing costs, that they have far more to challenge to take on, including televisions, which have not been an overwhelming success. By the way, he sees 28% upside in that stock, a price target of $79. And let's take a look at shares of Charles Schwab. That stock closing lower today as Morgan Stanley downgrades the bank for the first time ever. Morgan Stanley expects more pressure on Schwab's earnings than initially expected, and you can see shares down about 5%.
Yeah, Dave, I think deposit flows, they are really going to be in the limelight front and center when we take a look at a lot of these regional banks when they report here over the coming weeks. When we look ahead to next quarter, you take a look at some of the deposits that have been pulled from regional banks, and we've seen some of the concern ripple throughout the sector here. Schwab was far from the only regional bank play under pressure today. We were also looking at losses from First Republic. Piper Sandler, the analyst there that covers the regional banks, he lowered his price target on nearly every bank that he covers. So really pointing to the fact that there's lots of questions out there about what the future holds here for some of these regional plays. All right, and also taking a look at JD.com, 2 of the Chinese tech companies' subsidiaries filing for an IPO in Hong Kong on Thursday. Now, JD.com's property and industrials business filed for the IPOs, and JD.com would hold more than 50% of both companies' stock. You're looking at a gain of almost 8% today. So it looks like more of a split here among some of these larger tech plays.
It's been a tough go, though. The stock down 38% over the last 2 years, and really this comes directly on the heels of Alibaba's announcement that they will split into 6 separate units and IPOs in all of those categories. And that stock shot up yesterday 14% and had another positive day today as it continues to ride the momentum up 3.5%. So some relief overall after that crackdown on big tech in China seems to be reversing itself now with some good news for both of those companies.
It certainly does. All right, let's move on to Intel, because Intel stock climbing once again today, a move higher of just about 2% over the last 2 days, though. You're looking at gains of nearly 10%. Now, that move came after the company said that its new server chips are going to arrive sooner than expected. Investors seem to be excited about this. So let's talk about all of what this means here for the company going forward. For that, I want to bring in Angelo Zeno here of CFRA. Angelo, it's great to have you here. So we saw a pop in the stock today in Intel. It's really been going gangbusters over the last month, on track for its best month here in just over, 20 years? Enough to think that this momentum is going to continue?
I mean, it's tough to say. We necessarily wouldn't be kind of chasing the stock here, but listen, you kind of saw the news yesterday in terms of them announcing a new CPU server in terms of, proposed in 2025, that being their Clearwater Forest CPU. And I think what's most important here, or what we got indications of yesterday, is that execution-wise, everything is kind of going on as planned. And that was really kind of the problem with Intel's story over the last 5 years. It's the fact that execution has continued to be an issue with the company, with the prior management team, and that really kind of caused them to lose significant share. And now that we're actually seeing execution actually on par here, that at the very least is an incremental positive. Now you need to continue to see that execution play out here over the next 2 years. And I wouldn't necessarily say, it's clear sailing from here. And listen, this is a company that continues to burn cash, will burn cash through the rest of this year, likely next year because of some of their expansion initiatives out there. So personally, we wouldn't be chasing the stock here, but definitely good news from what we've seen here in recent days.
Of course, so much of the oxygen, Angelo, has been taken up by NVIDIA and their progress in AI and links to ChatGPT. How significant is the gap between Intel and NVIDIA and others in the AI space?
Yeah, listen, clearly these companies all specialize in different areas of the market. And on NVIDIA's side of things, it's all about GPUs. In our view, and what we've told investors out there, is the wallet share will go to the accelerators out there. And clearly the accelerators are the companies, the GPU providers, the FPGAs, the ASIC chips out there. But NVIDIA is really the only pure play to do it out there. In terms of Intel, their kind of bread and butter out there is really on the CPU side of things. And our view is CPUs are going to be a much slower type of business out there. As far as Intel is concerned, at least, if you are getting into the stock here, at least you're getting into it at the trough of a cycle, or at least we think we're at the trough of a cycle here. And again, they do have some great chipsets coming out here over the next 2 years, and as long as they execute there, it should be a positive for them. But as far as we're concerned, we continue to favor the more accelerator type of names, so an NVIDIA out there, to a lesser extent AMD.
All right, so Angelo, that's your take on semis on the chip sector. Let's talk about big tech. And I want to bring this up. There's a note out from Laura Martin over at Needham earlier today talking about Apple potentially buying Disney, what that would do for Apple's business. She's saying that that's going to unlock an upside of about valuation upside of 15 to 25%. Any strategic value for Apple in potentially buying Disney?
Listen, I think it would be absolutely great. If you think about Apple here and what they could potentially buy out there, Disney would make all the sense in the world from the perspective that that's a high quality type of company, an absolute great brand. And to have the opportunity to buy that would be great. In our view, though, that's not happening. If you're thinking about Apple here, clearly in the past they've never done anything north of $3 billion in terms of beats, in terms of M&A, and they're going to continue to do what they've done in the past, and that is buy back their stock and buy back it aggressively. So in our view, that's probably boring for investors to hear, but in our view, probably the right call.
So would you rule out M&A altogether for Apple in the year ahead?
I think it's tough because, and you have to think about Apple here. They typically do make about an acquisition per month, or at least that's what they've said in the past. So they do M&A, but it's typically on the smaller scale side of things, very small, incremental to their business. And when you start thinking about some of the regulatory issues out there and what, from the political standpoint, what they want to see from big tech out there, I think the last thing they really want to see is significant M&A or large M&A from these, bigger tech companies. So in our view, they probably steer clear of it.
Angelo, Apple also announced a Worldwide Developers Conference in June. Lots of talk about that mixed reality headset. How does that move the needle at all? How big of a hit, if we do get it, could that product potentially be, do you think?
Yeah, as far as we're concerned, in 23 and probably 24, it's not going to move the needle. I think it's a positive, an incremental positive, especially for their wearables segment out there. It's a small bit, overall their wearables division, about 10% of their revenue. So this has the potential, if you're looking at about $1 million to $2 million in potential sales here over the next year, it has the potential to move at least the wearables segment incrementally, but nothing kind of that's necessarily going to move the top line significantly. But again, it does increase their addressable market. We think it's important longer term for them to continue to find these new opportunities and expand that addressable market. So from our perspective, This is going to be a flagship device where you're going to see kind of lower price points over time, where they can potentially kind of generate more revenue over time. But over the next 12 to 18 months, it's not a big deal in our view.
Elsewhere in tech, still a lot of talk about a potential TikTok ban and what that could mean for other companies. You cover Snap and Google, who could benefit via YouTube Shorts. How likely do you think a TikTok ban is, and who would be the biggest beneficiaries in the space?
So in our view, we still place probably about a 35% probability it happens, 35 to 40%. And the way we would look at it here is probably 6 to 9 months ago, we would have placed less than a 10% chance out there. So the odds are definitely growing, and I think that's why you've kind of seen some improved enthusiasm in a number of these type of social media type names. In terms of the names that would be the biggest beneficiaries, we have pegged Snap as the biggest beneficiary out there, clearly because they're probably the smallest player within the space, and a name that kind of, if you look at who they cater to, very comparable to the TikTok community out there. So it's a name that we think can kind of see significant improvement in DAUs and also see some, potential incremental addition on the ad side of things. So that's the name that we think, at least from an immediate perspective, would be the biggest beneficiary if you think that's the ultimate outcome.
Great stuff. Angelo Zeno, appreciate that. CFRA. Coming up, Bed Bath & Beyond is warning of a bankruptcy filing again. We have the latest chapter in the struggling retailer's story of survival.
The consumer is resilient today. People are hopeful. And hopeful that they still can be prosperous in the future.
About 25 to 30% of your tenants are in fact tech, a Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
We're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies.
The impending recession we keep hearing is 6 months out.
What kind of trends are you guys seeing right now?
Still seeing good consumer demand out there. The question will be, how does that consumer hold up as we get to the back half of this year? But if we see that consumer hang in like they have through the first part of the year, we'll have the ability to bring production on and serve whatever needs are there.
This is still a very young market. We're still talking about fractions of people, and by the way, fractions of activity because of COVID.
Are you seeing any sort of deterioration in demand or differences in the decisions that people are making?
That's the flip side of this. There's some positivity for those who have some savings and investments, now can get a higher rate of return, even in FDIC-insured deposits, right? Yes. With money markets and CDs like they've not seen in over 15 years.
Bed Bath & Beyond ending the day sharply lower after it announced plans to raise $300 million through a new stock offering. You can see a 26% hit to a 59-cent stock. Inez Ferre here with the details. Inez, things not looking so good for the retailer, huh?
Not at all. And right now it is trading like a penny stock because it is trading below $1 a share, as you were just mentioning. Bed Bath & Beyond announcing that it will be selling shares in the open market. This is after its deal with Hudson Bay Capital is now no longer. Remember that back in February, the company had announced that it had made a deal with the hedge fund in order to raise funds, in order to keep going. And now Hudson Bay Capital has walked away from that deal, according to the sources that we spoke with, because of the spiraling downward impact of these stock and how it's yesterday it closed at 80 cents a share. It's trading at an all-time low right now. Look, Bed Bath & Beyond says it needs this money from this equity offering, in order to keep going, in order to afford its inventory, in order to keep operating, paying down its debt. And if it does not receive the funds from this equity offering, then it will have to file for bankruptcy protection. We have heard this warning before. Some of the risks that it's talking about right now is that it can't hold these relationships with vendors, unfavorable relationships with vendors, because, right, if the ship is sinking, then who wants to make a deal with you? Also, even retaining talent, it has been difficult for the company to retain talent. And just to mention, in case people don't know, when this company went public, Bed Bath & Beyond went public back in 1992 at $17 a share. It has, this is the lowest that it's ever been right now. You had Ryan Cohen, the activist investor that was involved temporarily with this company. He dumped his stake last year. This could be a case study.
Indeed, it could. $35 in January of 21, Shauna. 35 bucks to 59 cents.
It's been a quick decline. I mean, it's hard to figure out how they are going to avoid bankruptcy, but seems like a sure thing at this point. All right, Nandez, thanks so much. Let's move on to Ford. It was another trender here today. Ford raising the price of the F-150 Lightning Pro for the fourth time in the last year. Pras Subramanian here with the details. Pras, shares up at, about 2% today, so at least the street a bit encouraged by this, maybe help with some of the costs?
Yeah, I guess the street isn't concerned about the sticker shock here for people who want to get this F-150 Lightning. But yeah, you mentioned 4 price hikes here. So today they opened up the order books for the next batch of reservation holders, and then with that new pricing, so that Ford Pro base model went up $4,000 to $61,900-ish dollars there. It originally started at $42,000, right? So that's $20,000 in price hikes over the last year. Went from 42 to 48.9 to 53.7 to now 61.9. So really sort of hiking that base level up a lot. The more expensive Lariat and premium or platinum trims went up a couple grand here and there, but it's really this base model that went up significantly, because you got to say this is the cheap model is supposed to be a loss leader, and they just can't keep up with the losses, it seems.
Wow. Okay. Tesla, obviously the leader in the space. What can you tell us about Tesla's solar roof systems?
Yeah, the solar applications, the solar products have been sort of a mystery for Tesla. They bought Solar City with a lot of fanfare many years ago, and everyone thought they would be ramping up their installations. And new research from the group Wood Mackenzie talks about how back in 2019, Tesla said they want to install 1,000 roofs a week. They've only installed 22 roofs a week last year. So it's a significant...
22 total or 22 per week?
22 per week.
Okay.
Compared to goals of 1,000 per week, right?
Yeah.
So what's going on here?
Exactly. So how would they in the world ever ramp up some of those installs to reach that type of goal? I mean, how many years out could we potentially be?
I think the bigger question is that maybe they don't want to. The question is, what does Tesla want to do with their solar business? Mm-hmm. We thought we'd hear more about that at the Investor Day, and they didn't say anything about it, other than the fact that solar is a cheap way to collect, green energy. So the question is, do they have a new product coming out? Are they going to roll out a new product? And that's why they're pulling back on some of these installations. They've canceled installations. They're funding people's money. So the question is, what's happening? And we have no clarity as to what they're doing with the solar business. And right now, 22 a week is nothing, really.
Yeah, certainly. All right, look at Tesla's stock. Not moving much today, obviously, because maybe we're just waiting for some news on what exactly the plans are with that. Pras, thanks so much. Well, coming up, OpenAI facing a complaint by the FTC, and it could have serious consequences for ChatGPT. We've got the details for you next.
OpenAI is facing a new complaint filed with the FTC today over the company's popular ChatGPT product. Yahoo Finance's Dan Howley here with the details. Dan, what are we learning?
That's right, Dave. This is from the Center for AI and Digital Policy, and they're basically calling for the FTC to force OpenAI to stop what it's doing as far as advancing its practices on GPT-4. Now, one of the statements that they say in the complaint is OpenAI is a California-based corporation, has released a product, GPT-4, for the consumer market that is biased, deceptive, and a risk to privacy and public safety. They also go on to say in the complaint, let me just pull it up here. Let's see. Here we go. Sorry about that. The Federal Trade Commission has declared that the use of AI should be transparent, expendable, fair, and empirically sound while fostering accountability. They say that OpenAI's product GPT-4 satisfies none of those requirements and is calling on the FTC to act here and enjoin them from further commercial releases of GPT-4 and the establishment of guardrails to protect consumers, businesses, and the commercial marketplace from AI. So basically, the fear here is something that we saw in that letter that was signed from researchers the other day about the rapid advancement of AI technologies like GPT-4, GPT-3, 3.5, ChatGPT, and other generative AIs. Don't forget, this isn't just OpenAI that's doing this. We have other companies that are also in the generative AI space. And, it comes shortly after that big kerfuffle around the generative AI image of the Pope walking around, and then those other generative AI images of Trump and Macron being arrested. So, this is something that we're going to continue to see, these kind of backlashes to different parts of generative AI.
Jim, some of these concerns are being brought to light at a time when a number of these tech companies that are in the AI, that have AI as part of their businesses, are cutting some of those positions within the company. What can you tell us about that?
Yeah, look, I mean, when I was at the Microsoft event for them rolling out Bing and at the Edge browser, they had a panel specifically dedicated to AI ethics, and they trumpeted that heavily. And then shortly thereafter, they let go of that team. And now, I'm sure Microsoft would say, look, we invested in this. We have these guardrails set up. We know what we're doing. But, it's not just Microsoft. We had Twitch, we had Twitter, other companies laying off these ethical teams. And, no, this is not Skynet. We don't have Terminators running around. Self-driving cars aren't like plowing into people like that Stephen King movie. I forget what it was. I want to say Christine, but that doesn't sound right. But there is a fear that these kinds of technologies could be abused. And, part of that is the spread of disinformation, misinformation. People may rely on them. And a lot of the companies that put out these technologies specifically have to say, look, they're not always going to be correct. Microsoft does that when they release a new product. Google will put that on as a warning on its Bard product. So, there's this kind of fear that, yes, these are advancing. Yes, it's incredible technology, but is it ready for prime time yet? And, clearly this organization does not see that as the case.
Indeed. All right, Dan Halley, appreciate that. Thanks so much. Coming up, shares of EVgo popped after it reported fourth quarter earnings this morning. The company's CEO here to tell us how she's planning to put a charge into the company's growth plans. Next.
Artificial intelligence, machine learning, all topics discussed heavily in tech in 2023. But now you've heard all the rumors. AI is coming for your job. It's going to steal your family. It's going to eat the food off of your dinner table. Folks, how much of this is actually true?
Generative AI is here, it's in everyone's palms, and it's not going anywhere.
To find out more, we went straight to the experts to discuss where technology meets culture and where the South met the Southwest.
We're here at South by Southwest. We're here in the Lone Star State. We're posted up on what is the most musical part of Austin, Texas.
Webster's dictionary defines AI as the simulation of human behavior in computers. Sounds harmless, right? But with the exploding popularity of generative chatbots like ChatGPT, many people are re-examining where they stand on the technological food chain. Ian Beecraft is one of the leading voices in deep tech and AI. His company, Signal and Cipher, teaches large companies about how to adapt to new technology. Ian says, we've only scratched the surface of what AI can do.
We are at the very beginning of one of the biggest revolutions in knowledge work in human history. And a lot of people look at this as a large step change in the way that we do our work. What we're doing is we're digitizing skills the same way that we mechanized physical labor in the Industrial Revolution. You're doing things at a scale, at a volume, and a breadth that human minds aren't really capable of.
So will the rise of AI lead to job losses? And if so, why should we embrace this technology? We met with Gary Kasparov, the former chess grandmaster, famous for his series of chess matches against the 1980s supercomputer Deep Blue.
Every new technology in the past threatened jobs, actually destroyed jobs, destroyed industries before creating new opportunities. So AI is not an exception. Machines made us stronger in the past, made us faster in the past. Many jobs we're doing today, yes, in my view, they are like zombie jobs. They're already dead, they just don't know it yet.
Okay, so far, our experts have not painted a particularly rosy picture for the future of mankind, so we went directly to the source. You know what they say, keep your enemies close. According to ChatGPT, artificial intelligence has the potential to greatly impact the future of humanity in both positive and negative ways. On the positive side, AI has the potential to improve many aspects of our lives. That doesn't sound too bad, but it goes on. One major concern is that as AI systems become more advanced, they may become difficult to control, potentially leading to unintended consequences or even catastrophic outcomes. Therein lies the concern, and why many in the tech industry are approaching AI with a good deal of caution.
People are getting freaked out that, hey, what is this thing? Can we trust it? I see both sides of the argument. And in some ways, there's a lot of opportunity, but on the other hand, we also have to be careful just with any technology.
That was Pulkit Agrawal, assistant professor of computer science at MIT. So instead of thinking about AI as a replacement for human beings, according to Pulkit, we should think of AI as a tool. Like the invention of the PC, AI may actually improve our work and make humans more efficient in performing our day-to-day tasks.
If an AI system can look at, say, CT scans and make a diagnosis, is it going to replace a doctor or not? I would say no.
While the possibilities for AI may seem limitless, it could be the key to unlocking the potential of the human brain.
The Terminator and Matrix and other things that brainwash the public. Machines cannot dream, so we should dream. Yeah. We should think how we can actually cooperate with machines. I believe there's the opportunities are absolutely endless.
Let's take a look at EVgo, a provider of EV charging stations. Now, it is a trending ticker today on Yahoo Finance. Shares closing up just about 22% after reporting a huge jump in sales revenue, reaching just over $27 million for its most recent quarter. That's up nearly 300% from just a year ago. So joining us now, I want to bring in Kathy Zoe, CEO of EVgo, as well as our senior autos reporter, Pras Subramanian. Thank you both. Kathy, it's great to see you. So certainly your stock has really been going gangbusters, up nearly 60% since the start of the year. What's the biggest driver behind some of that massive growth that you're seeing in your business?
Electrification of transportation is happening. I mean, it is, $1.2 trillion is getting invested in making EVs by the car companies, and all of those new EVs need to get charged, and it's a massive sector. We've been around for a while, and we do what we do really well, and we're continuing to, exploit that growth to make money for our investors.
Hey, Kathy, Pras here. So, noting in your release about how energy outputted increasing tremendously year over year, things like that. Also talking about your partnership with Flying J, the travel centers there. How is that going? And are we going to see more of these partnerships with those types of high traffic partners going forward?
Well, look, I think so. Look, our partnership with Pilot Flying J is really, really fun. I mean, one of the things that, they're on all the highway corridors across America. I mean, most Americans live within a short distance of a Pilot Flying J if they live near a highway. And so us being able to electrify those is going to improve drivers' ability, their confidence in being able to buy an EV and go on a big road trip. And so we love that partnership. The federal government has a commitment to having fast charging stations every 50 miles on America's interstates. So that's a big sort of, what's on the come and what's going to be happening over the next few years.
So kind of makes you question, what are the ideal locations for some of these public chargers beyond, let's say, highway locations?
Well, it's interesting, Pras. We've been around since for more than a decade. Before this recent project with Pilot Flying J, EVgo focused mostly on metropolitan areas because that's where most of the driving gets done. And our thesis is, since electricity is everywhere, we put our chargers where people are going to be anyway. So our favorite places to put our fast chargers, and I'm looking at some of the footage as we talk, is in grocery store parking lots, big box stores, municipal parking lots that are near a bunch of other convenient things, parks where your kids are going to go play, because you're going to spend, I don't know, somewhere between 15 and 30 minutes charging your EV. You might as well go and get a cup of coffee while you do it. So we love being near those amenities, and that's where most of our metropolitan chargers are located today.
Kathy, I got to ask you, because clearly there is a massive need now for chargers, but we did have the headline a couple of weeks ago that Tesla does have plans to open some of its charging locations to all EVs. What kind of effect or impact do you see this having on your business, if at all?
Well, look, EVgo charges all EVs, so we charge Teslas as well, and we love the fact that there are so many Teslas that are out there. The market, the need for fast charging station locations is enormous. It's immense. And so I think that this rising tide is going to mean that Tesla is going to have some folks charging on its stations that are non-Teslas. I can tell you that those Tesla charging stations are pretty busy with Teslas today. So we're hoping that the converse is true, that some of those Teslas are going to come over to EVgo while we continue to charge the dozens and dozens of new EV models that are coming to market.
Kathy, you mentioned the Biden White House talking about that national charging network with the goal of 500,000 chargers by 2030. I've seen some reports by McKinsey, for instance, that talk about we need millions of chargers by 2030, not just 500,000. So how do you think we bridge that gap and sort of get there with where we are right now?
Look, one of the things, once there's a critical mass of EVs on the road, the chargers will all come. What's clever about the policy initiatives is that they are building a bridge between when there are enough EVs to have this be completely sustainable and today, where we actually those grants, those funding support programs help make it possible for private companies like EVgo to have the projects pencil. So we're really, really excited about that. We won't always need government incentives to extend the charging network. But today, when frankly, we went from, like, it's growing. Last year was 3% of cars that got sold were EVs. This year it doubled to 6%, but we're still a far cry from having every car that gets sold be an EV. So it's in these early moments that government policy, government incentives can help build that bridge for capital markets to create that confidence to invest in this infrastructure that will be absolutely essential, going forward.
So kind of a follow-up here. When do you think we'll get to the point where these chargers will be as ubiquitous as gas stations, for instance? Like, how long will that take?
How long? Well, we don't like the gas station model because, as I mentioned, we actually prefer that you can charge and do something else at the same time. But in terms of ubiquity, I think that we're on that trajectory now. EVgo and others, we're all building right now to satisfy the demand. We're thinking that there's going to be a 7x increase in the number of EVs by 2030. There will similarly be an increase in the number of fast charging locations, and let's not forget workplace locations. So what we do is we build fast chargers where the dwell time of that location matches a fast charge time. So where are people going to be for 15 to 30 minutes? That's a perfect spot for a fast charger.
Kathy, what about
workplace? You're going to be there all day. So those are level 2. Sorry, go ahead.
No, but Kathy, what about the Biden administration's stressing just made in America? We know that is a headwind potentially here for your company. Is that going to slow the rollout of your stations, at least in the near term?
In the very, very near term, what we're doing, we're deploying ultra fast chargers that at the moment nobody makes them in America, but our two suppliers that we're currently using are already having factories under construction. So the policy initiatives are helping to create that onshore capacity to create jobs, do the Made in America. Absolutely. What it will do in the near term is probably shift some of those stations that get deployed that we're thinking we would deploy in 2023. Those may shift to 2024. So it's not a material change, but there will likely be a slowdown in 2023 for things that are able to get built given the new guidelines that have come out from the federal government.
Kathy Zoy, great stuff. Thanks so much for joining us, CEO of EVgo. We really appreciate it. And of course, thanks to Prof as well.
Thank you.
Well, coming up, cannabis operator Verano's CEO has a message for skeptical investors. He'll share it with us next.
Recreational marijuana is now legal in 21 states, including the 60 million plus residents of the four biggest U.S. states in New York and California. And yet the investor story remains challenging, to say the least. The four biggest U.S. cannabis companies' stock prices are down between 55 and 70% over the last 12 months, with no legislative progress in sight. Joining us now to talk about the investor story is the co-founder and chairman of one of those companies, Verano Holdings CEO George Archos. George, great to see you. Verano Holdings stock down today after reporting Q4 earnings. It's a familiar story in the industry. You got record revenue on one hand, widening losses on the other. What'd you learn in Q4?
You know, it was a great year for Verano. I think a lot of focus last year was on safe banking and that passing and federal reform. Unfortunately, that didn't happen despite all the momentum. And, we didn't build our company based on federal reform. We're building a strong company that's going to be here for years, and we expect to thrive and not only survive in situations like this. So despite the economy being down, and, Verano's set up for a bright future, and we're really excited about it. We have a phenomenal team. We're, really focused on free cash flow this year and knocking down debt. And we're also looking at great deals on the horizon. So we're excited about what's happening.
I apologize, George. I said the stock was down. It is up 1% on those Q4 earnings. So apologies there. What would you tell skeptical investors in the space? What separates Verano from the other companies in the sector?
We always build this with a long-term focus. For us, we don't do anything based on short-term bumps in stock or, we always unfortunately takes things the hard way. We're one of the only companies that own all of our real estate, or the majority of it. We've been focused on our people, process, and products since day one. We started from the ground up, winning licenses organically, and building our business from our cash flow, which has been a little bit different from some of our other peer set. So we have a very strong foundation here. And again, like I said, last year at the end there, the tail end was a little disappointing. And I know investors are a little weary of cannabis, but there are a handful of companies out there that are going to remain to be strong. And in the current situation, to be perfectly honest, we're going to thrive. We're well capitalized, strong balance sheet, good people. We're in great markets. We have a fantastic geographic footprint that we've set up over the last few years. We've built out our facilities, and we're poised for really strong growth over the next few years, despite what's happening. You know, cannabis has become a staple. We believe it's very recession-proof, and we're excited about what's going to happen.
How do you describe an environment as an operator? How challenging is it when you don't have traditional access to banking services, when you can't write off business expenses? Just how difficult is that as an operator?
You know, since day one, we've always had the cards stacked against us, right? I mean, access to banking hasn't really been there. We deal with local banks, credit unions, but despite that, we've always been in an environment where we have to be in survival mode, right? And now, despite safe banking and no federal reform, we're in thriving mode. You know, obviously we have to deal with what's going on in the economy today and pricing pressures, inflation, et cetera. But a company like ours and a handful of others, we're really poised to succeed in this environment. Unfortunately, what's going to happen here is a lot of the smaller operators who don't have access to banking, who aren't well capitalized, we might see some failures there. And that's something that we don't want to see. A company like ours is helping new entrants to the space. Social equity JVs that we're doing in Connecticut and other states where we're helping social equity applicants get their businesses up and running. But we haven't had any help on the federal side, and it's unfortunate. And I know it will happen sooner or later, but for right now, we're going to continue with our head down, run our business, and be very selective with our opportunities moving forward.
What's your level of optimism on either federal legalization or safe banking? And what would be the message to those skeptical? And let's just focus on the Senate primarily, because the House repeatedly passes safe banking. What's your message?
The messages are not helping the little guys, right? And to be perfectly honest, they're helping companies like ours that are larger, because we are well capitalized. We have strong businesses and foundations, and they need to do this for the new entrants into the space. Yes, it will also help a company like ours, but really to help these new social equity applicants coming into the space in all these different states, we need to have banking reform. That's, to me, a no-brainer. But we can't push anyone, right? So we're going to continue to lobby on our side, prove our point, show that cannabis is safe. We provide consistent products in these medical markets, adult use markets, and we're going to continue to do our job. And hopefully when that time comes, we'll be able to enjoy that as well.
I mentioned New York and California, which ought to be the example of others to follow. Instead, it's been the direct opposite. California, about a decade in, the illegal market has just overtaken the legal. It's bureaucracy and the black market that's just forced many MSOs to move out of that state. New York, it's early, but we're talking about 1,400 illegal operators, a handful of dispensaries. What went wrong in California, and is New York poised to follow the same path?
Well, to be honest, yeah. I mean, they're not cracking down on illegal operations. The whole point of putting legal operations into place is to make sure that our consumers have a safe, consistent product. And that's not happening. We lab test all of our products in every state. California, there's so much gray market, black market. The government is not shutting them down, and it's very unsafe. And that's when you have difficult situations. And unfortunately, some of that falls on us, even though we're doing everything right. And now New York is doing the same thing. You have 1,000+ illegal operators creating a thriving black market, so the state isn't getting the taxes that it should be for its citizens, and they're buying illegal product that's, you know, it might not be safe. You know, you have all these issues with fentanyl laced things going across the market, getting to kids. It doesn't make any sense. You know, and in New York, for example, there are 10 operators there that are, you know, legal medical cannabis operators that should be already flipped over to adult use, providing good, safe product. And it hasn't happened yet. You know, and what's the reason?
It's astounding, isn't it? George Archos, Verano Holdings founder, chairman, and CEO. Good to see you. Thanks so much. All right, coming up, Aaron Judge has already gone deep on Major League Baseball opening day, but if you want to see all of his home runs this season, you'll need to know about the league's streaming options. We'll cover them for you next.
Let's take a look at a couple of trending tickers after hours. We have Nikola, Canoo, and Rumble. Starting off with Nikola, you're looking at a loss of nearly 6%. Now, this EV maker falling towards another all-time low, announcing plans for a $100 million share offering. Now, they disappointed the street back in February with its revenue numbers. Also, the fact that they only anticipate or project to produce up to 500 or fewer vehicles this year. And you can see the stock has been under a tremendous amount of pressure. This year alone, it's off about 35% over the last year, off about 87%. A number of issues going on with Nikola, but that EV maker under pressure today. Let's flip it over to Canoo here, another EV maker, off just about 0.5% here. Not a huge move after hours. The company saying that it did deliver its first vehicle, the LTV, to the U.S. Army during the last year in 2022. They're also focused on bringing more facilities online and scaling production as they look ahead to 2023. Year to date, you're looking at a loss of just about 49%. The company did report a loss of 25 cents for its most recent quarter. So under a bit of pressure here in extended trading. Let's round it out with Rumble. Now, this video platform here really shares soaring on the heels of its latest report, up just about 30%. Now, the company reporting that its global monthly active users reaching 80 million. Putting that in perspective, that's up 142% from just a year ago. Year to date, you're looking at gains of just about 56% and closed today just above $9 a share. Dave?
Thank you very much, Shauna. Today is opening day in Major League Baseball. Well, there are some major rule changes on the field, like the 20-second pitch clock that could be a game changer. You'll need to be aware also of the league's streaming options. If you want to catch all the action, Apple TV Plus will begin streaming the second season of its Friday Night Baseball broadcast on April 7th. However, unlike last year, you'll also need an Apple TV Plus subscription. Currently, that's about $7 a month to tune in. But Apple, not the only tech giant stepping to the plate. Amazon's Prime will also exclusively broadcast 20 Yankees games this season after broadcasting 21 last year. That'll come at no additional cost to Prime members in the Yankees home market, and the first such games take place on April 4th. Peacock will stream several Sunday games. ESPN Plus will also get in the streaming MLB games this season as well, Sean.
And there could be even more changes on the horizon. That's because Diamond Sports Group, the Sinclair subsidiary, broadcasting games for 14 MLB teams under the Bally Sports brand, filed for Chapter 11 bankruptcy earlier this month. Now, Diamond must continue to pay each club their rights fees, or teams could break their contracts with the MLB, potentially taking over broadcasting duties. Lots of changes in store for this season, at least when it comes to broadcasting. But we know my biggest issue with baseball is the time. So maybe the pitch clock is going to help speed up the games. Clearly, that has been the case during the preseason. But still, a couple of hours for a game, I think that's the biggest issue facing baseball right now, clearly.
I don't know if they're going to convince you, but no. I think others that are closer to the middle, it's going to be a little bit quicker, not an overwhelming change. So far, spring training games are 26 minutes faster, which is a huge difference. I think it'll make the game feel a lot faster, but we alluded to these massive streaming changes that are really going to be interesting how it takes, because remember when Aaron Judge was in pursuit of the home run record last year, a lot of fans really took issue with not being able to see some games because they don't have streaming platforms. Major League Baseball fans tend to skew a bit older and more traditional and don't have streaming platform subscriptions. So it's going to be an evolution, but MLB has to get there. Every other sport is. Really curious about that Diamond Sports development. That is 14 teams, and they do plan to continue broadcasting games, but at some point, you're going to need 14 streaming deals or somebody to really step up to the plate with a massive financial commitment.
But my question to you, though, is yes, maybe this pitch clock is going to help speed up the game, but they need to do something to capture Gen Z, to capture your kids. You've talked time and time again how your kids don't have the interest in watching a full game, and that's in fast-paced sports. So you move that over to the MLB, and now it's on streaming networks, which you think would then appeal to Gen Z. I don't think they're going to be watching it, and I think that's a massive issue for baseball, and the fact that the popularity has really fallen off a cliff.
TikTok.
Get
it's TikTok.
On TikTok.
Everything needs to go in the direction of TikTok. They do watch a lot of baseball highlights. They are putting forward a lot of interesting superstars that get the social media, they want some swagger on the field. So I think it's going to get there. You're not going to see a lot of Gen Z people, kids sitting down and watching 3-hour games.
Going to the games are
but
fun.
They may not need that. You're seeing TV deals continue to escalate. You're seeing team valuations continue to go through the roof. Overall, it's a pretty healthy situation for baseball. Record revenue last year.
Which is pretty incredible, given everything that's going on. All right, well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. The White House unveiling its plan to strengthen banking regulations in the wake of Silicon Valley and Signature Bank's collapses. Now, among the proposals to reinstate some of the rules that were rolled back under the Trump administration, and also strengthening the bank stress tests.
And more layoffs in the tech sector. Streaming device maker Roku announcing a second round of job cuts. The company will cut about 6% of its staff, or around 200 jobs, in order to trim costs. The move sent shares lower, the stock closing down nearly 4%.
And finally, one of the big winners of the day, EVgo. Now, shares of the EV charging company soaring today, closing up 22% after reporting its fourth quarter results that beat the street's expectations. The company's CEO telling us that the need for fast chargers is, quote, immense, and that the company is focused on putting chargers in places that people are visiting, such as grocery stores and big box retailers. Makes a lot of sense.
Indeed. That will do it for us on this MLB opening day. Yahoo Finance Live will be sure to come back tomorrow, 3 o'clock Eastern Time. All your coverage leading up to and after the closing bell.